As Australians hold out for an interest rate cut, shoppers have come here hoping to find a bargain.
I know I'm paying for, extra for everything. It's just amazing how everyone follows suit and put everything up.
Which is really tough. I was doing childcare before, but I'm going back to nursing just to get a better pay.
Just buy all I need so I don't waste food. And I turn lights off so I don't waste electricity.
But there is some good news. Underlying inflation, which the Reserve Bank watches closely, fell to the lowest rate in 3 years in the 12 months to December, coming in at 3.2%, down from 3.6% in the September quarter. The RBA's target range is between 2 to 3%.
This inflationary pressure that's less than they're anticipating means they don't need to keep rates as tight as possible, and we think there's a rate cut coming in February.
It's looking like a year in which we'll see maybe 2 or 3 rate cuts, but possibly not too many more than that.
There was also progress on headline inflation, which includes more volatile price changes. It rose 0.2% in the December quarter and 2.4% for the year. Prices for alcohol, tobacco, domestic flights and accommodation went up, while electricity bills tumbled as households continued to receive government rebates. Prices for fuel, new homes and fruit and vegetables also fell.
The worst of the inflation challenge is now well and truly behind us, and that's one of the reasons why we are confident but not complacent about the economy in the year ahead.
This is not mission accomplished. Inflation has remained too high for too long in Australia, and because of that, interest rates have stayed too high for too long, and Australians have paid the price.
The drop in underlying inflation now puts considerable pressure on the Reserve Bank to move on rates. Financial markets are certainly excited about it, pricing in a more than 90% chance of rate relief in February. A rate cut would be welcome news for restaurant owner Julie Tran.
Alexa?
She's not only got her own mortgage to worry about, but her customers too.
The last thing that they have money for is to spend money to go out for a dinner or a lunch.
Adding to her woes is a weaker Australian dollar, which is making the cost of importing ingredients more expensive.
As a customer, they don't see all of those costs and they just see the cost on the menu, and sometimes they think that it's too expensive, but then they don't really see what's behind the scenes.
Financial pressures felt across the economy.
Let's get more now on what the inflation data reveals about the economy. NAB's chief economist is Alan Oster, and he joins me. Welcome. Markets are overwhelmingly pricing in a Reserve Bank cut in February. Do you now expect to see a rate cut?
We're reviewing our call. We were not so much surprised about inflation today. It was a bit below what the Reserve Bank and markets expected, but we roughly got it right. But what we're considering is what does it mean for the rest of the year? And so we'll probably make a decision on it overnight and come out tomorrow.
If financial markets continue to price in a more than 90% chance of a cut, what would be the fallout if the RBA holds firm?
Look, I think to be honest, as an economist, I think it's a 50-50 call. The lowest CPI has given the opportunity if they want to do it. I think whether I can tell the difference between May and February doesn't really matter that much. It might matter to psychologists, etc. But really more important to me is where does the RBA end up? And we still have them around 3%, probably early next year, and the markets are still 3.5%. So I think essentially it basically doesn't make a lot of big picture difference whether it's February or May, but it's close. And you look at the forward expectations and you could find that you're at 2.5 for a trim mean by, let's say, September quarter this year. And in that sort of environment, you probably don't need a tight monetary policy. You probably need something that's more neutral.
Given that you say it probably doesn't make a lot of difference when the RBA cuts, one is coming in the first half of this year at least, why wouldn't the RBA cut in February?
Well, the issue they've got is that the economy is still okay. The growth rates are slow, but the unemployment rate's got a 4 in front of it. And so that says that the economy is not in, say, the New Zealand example where unemployment's now 5, or later this week will be 5. So, you know, it's not that you need an emergency cut. And we're still growing. The expectations are that we'll probably do better this year than last year. So when they cut, it's going to be gradual sort of cuts. You know, there's a lot of people will take a political angle on whatever they do. So, you know, the government like a rate cut. The opposition probably wouldn't until after the election. But ultimately, I think the Reserve has got to sit back and say, on economics, what should you do? And I think it's a line ball decision. So would I be completely surprised if they didn't go? No. But I think the odds are probably moving closer to that they're more likely to go than not go.
Should we be looking at the jobs market and the unemployment rate in a slightly different way? The unemployment rate at 4% is at historically low levels, but the part-time share of employment is at 31%. Is it fair to say, really, that the jobs market is really very tight?
I think it is fair to say the job market is quite tight. So by the end of 24, we're expecting unemployment to be closer to 4.5, and the Reserve was talking about 4.3. So we've all been surprised. I think the labour market ultimately will produce a higher level of unemployment in the middle of the year, but, you know, let's say it's 4.2, 4.3. That's still pretty low. And so I think the labour market's good. Consumers are still juggling. What they're doing is they're saying, right, I'll try and get some more money, or I'm going to cut back on what I'm spending. So the economy's not roaring away, but it's not falling over either.
Is it clear that inflation would be making steady progress downwards even without the federal government's energy subsidies?
I think that's more difficult. So services inflation is still 4.3%. What we're seeing at present is some volatility in things like transport prices. The big impact of the government's policy is to affect the headline. So it doesn't really affect the trim mean or the core level so much, because things like electricity, childcare, all those sort of things are basically trimmed out. So they're not counted in the core measure. So, and if you look at the headline measure, it's what, 2.4 for the year, vis-a-vis something like 3.25.
Okay. What do you expect to see when those energy subsidies come off in the middle of the year?
Well, it means the headline inflation will start going back up, provided they come off. So, you know, that's why the Reserve will be looking at the core measure that won't bounce around according to what the government's been doing. So I would say the headline numbers will go higher, but the core will continue to come down.
Okay. Alan, how many rate cuts do you expect to see this year?
We would expect, if you get one in February, we'd say 1.25. So basically 100 basis points from 4.3 to something like 3.3 by the end of the year.
Just one more question. Does moderating inflation now come with a significant downside risk for the RBA if it does indeed choose to hold rates firm at the February meeting?
I don't think it makes a lot of difference whether they start cutting in February or May. So I think the worst outcome is that the Reserve cuts and then suddenly has to increase again at the end of the year. That would be a pretty bad result. But I think it's more likely that they essentially just judge sometime in the first half of this year they're going to be starting cutting, and they'll do it in a slow rate. They won't be doing 3 or 4 in a row, if you know what I mean, like the Americans did at one stage.
Alan Oster, it's always great to hear from you. Thanks for joining the program.
Thanks, Kirsten.